me and the other two fund managers got together and we said, how can we open up a real estate fund that does a little bit of both and has multiple streams of income coming in? It's no different than what I would suggest to somebody from an investment perspective, right? Have your day-to-day job, which is important for your retirement plans and your benefits and, regular income, but have multiple streams of income.
Welcome back to the Money Seed Podcast. My guest today is Heather Dreves. Heather is the Director of Funding at Secured Investment Corp. Heather, welcome to the show. Heather, tell us about Secured Investment Corp and what do you do?
That's a great question because we do a lot of things. But to put it in a very quick overview, we are a real estate investment company. And we assist both active real estate investors as well as people that are looking to passively invest in real estate. So, we've got clients everywhere from the person that's boots on the ground, buying real estate, fixing and flipping properties, sometimes for resale, sometimes to hold them as a rental asset, all the way on up to the client that maybe just retired or is planning for retirement and is looking at opportunities to grow their wealth and create cash flow outside of their traditional resources like a 401k or just their savings account. And so we do everything in between.
Got it. So when you say that you're investing in real estate, do you actively own and manage properties, or do you just find people who need money to invest in real estate and connecting with people who are lending money?
Yeah, that's a great question. We do both. So I tell people we practice what we preach. And so our active investors that are looking for funding for their real estate projects, we write our guidelines and we underwrite our deals according to the buy box that we use. So when we're lending the money, we are looking for people that are looking for short-term loans that are doing value adds, meaning they're buying real estate that might be distressed and they're looking to improve the value of it and either exit our loans by selling the property for a profit, or sometimes they're looking to exit our loans by refinancing because they're holding it as a rental property. We also practice that model in our funds that we manage. And this is the way that our passive clients invest their money. They're looking at, hey, I don't want to deal with tenants and toilets and a contractor. I like real estate and I want something to diversify the current investment portfolio I have. And I want to add real estate. I just don't want to be as hands-on as this guy. Our buy box is the same for our funds. And so we actually do acquire properties locally in our specific market, which is the Pacific Northwest, state of Washington up through Idaho. And the other thing that we focus mainly around is residential real estate, which makes us pretty different. There's a lot of real estate funds out there, right? There's syndications, there's guys that are buying self-storage units, multifamily, commercial. We stay in our lane and our lane of expertise, and that's really the residential market. So single family up to 4 units, and really specifically in that affordable housing market space. We want to invest in properties and we want to lend against properties that are properties that there are more people trying to get into, first-time home buyers, things of that nature. And then also assets where if we did want to keep them, we could cash flow them and rent them. So that's really that sweet spot for us, which again is going to be that residential market.
So if I put on my investor hat and I say, Heather, I don't want to deal with the 3 T's of real estate, like the termites, the tenants, the toilets. Yeah. I just want to give you some money. What will you do with the money that you take from me and put in a fund?
Yeah, so our funds are also unique in the sense that I call them a diversified portfolio. And what I mean by that is you have a lot of funds that are either doing value add or they're just debt funds, meaning they're lending money out, right? 11 years ago, when we opened up our first fund, me and the other two fund managers got together and we said, how can we open up a real estate fund that does a little bit of both and has multiple streams of income coming in? It's no different than what I would suggest to somebody from an investment perspective, right? Have your day-to-day job, which is important for your retirement plans and your benefits and, you know, regular income, but have multiple streams of income. We wanted that same model for our funds because the biggest concern you have as a fund manager is, you know, one is raising capital. The second is deal flow. You know, what if your deal flow dries up? You know, that's a big concern with debt when you're lending money out. What if people stop borrowing money from us? But then also on the other side of it is when you're acquiring properties, what if the deals dry up? What if there aren't as many deals? We saw that through COVID, you know? And so ours are diversified, meaning that we take a portion of our fund and we lend that money out. So we get profit coming in from interest payments, things like origination points. We secure those assets by a lien against these properties. So these are first lien debt components. But then we also buy properties and we acquire them. And we have a massive team. You know, we have loan officers and loan analysts and underwriters and a servicing company that's making sure that, you know, these deals are viable, that people are making their payments and they're paying us off. And then on the acquisition side of things, we have an acquisition team that's going out, finding the deals. We have a contracting crew that gets in and rehabs them as soon as we acquire them. We have a property management company. And so what I would tell people is, if you don't want to deal with the headaches of all of that and trying to find the deals, a real estate fund is a great option because you're reaping the benefits of it, right? Those profits all flow back into the fund, and that's how the earnings are paid out to our investors. But you don't have people calling you in the middle of the night telling you, hey, my toilet's plugged up, or you have a contractor calling saying, oh yeah, you know, we were supposed to show up, but we're out another 2 or 3 weeks, you know? And so this is a way that, one, you don't deal with those headaches, but the second big benefit is you're diversified. Rather than taking all your eggs and putting it in one deal, you could take some capital, put it in a fund like ours, and you're diversified over multiple assets. And so I think the funds, back to your question, give that opportunity, right? You don't have to have as much capital. We have a fund that you can invest as little as $1,000 in a real estate fund, and you don't have to be an accredited investor to go into. So for people that have small dollars or maybe aren't at that accredited investor level, they can get started in that rather than having to have a bunch of capital up front to buy a piece of real estate. Then you got to pay to rehab it, and then you're going to have to sell it. So I just think it's better diversification, less headache, and you don't have to have as much capital to get started.
And how often are the payments made to the investors?
On a monthly basis.
Wow.
So we pay out earnings monthly. Now, there is another component to it that I haven't even brought up yet is we work with a lot of clients that are taking advantage of what they call self-directed accounts. And so these are accounts that people can either move IRA accounts into, and they can move them out of your more traditional options, right? Bonds, CDs, things of that nature. They can actually set them up with what is called a self-directed custodian, and then they can start to dictate where they want to invest their money. The biggest challenge with those kind of accounts is those companies, those custodians charge a lot of fees. You know, there's fees for monies going back and forth. And what we hear a lot of times is, okay, great, I was happy with this investment I made with somebody else, but now their earnings are coming back into my self-directed account, and now they're sitting there, and I got to wait till I have enough to go deploy it because all these investments have a $50,000 minimum. They can actually set those kind of accounts up with us where they reinvest their earnings. So hypothetically, Gabe, you could come to me with your self-directed IRA. You could invest in our fund. Every month you would know what your earnings were, but we'll reinvest them at our level. We're going to let your custodian know at the end of the year what the market value of your account is. And now you keep, one, the money working all the time, but now two, you're also compounding your earnings. So you can really get creative. I've had even people say, you know, I'm going to put some money in, but I want half of my earnings paid out because I need a little bit of cash flow, but I want to roll the other half. So you can even set your accounts up that way.
Amazing. Quickly run me through the various different types of funds you have. How big are they? And what kind of investors do you need to be accredited versus non?
Yeah. So back in the day, and you probably know this, accredited investor funds were really the only option 10, 11 years ago. I mean, that was the SEC's rule. You have to be a high net worth individual to invest in these kind of investments, which quite honestly, I think is just silly. Like, why should the why should the wealthy be the only people that can take advantage of these types of investment options? So we have what we call Fund 2 that is open to accredited investors only. It was open 10 years ago. At that time, that was the only option. That fund actually has a $50,000 buy-in initially, and then they can invest any dollars thereon after with a very short tie-up period. For those of you that know syndications, your money's tied up for 3 to 5 years. Ours has a 12-month tie-up period. So very short tie-up period. So that's Fund 2. And people always ask me, well, what happened to Fund 1? Fund 1 was just a 5-year fund, and we had to wind it down. So most of our clients that were in Fund 1 rolled over to Fund 2. So that's Fund 2. Fund 3 is the fund that is open to everybody. So it doesn't mean that only unaccredited investors go into it. I have a gentleman just yesterday that put money into it because he's accredited, but he had a small dollar. He didn't have 50,000. All his money was deployed. So it doesn't mean that it's only for unaccredited investors, but everybody can go into it, and it's got a $1,000 minimum investment. So we wanted something. 4 years ago, they changed some of the securities laws, and they said, okay, we'll open this up, but we're going to limit the consumer, and we're going to protect them and tell them they can only put in 10% of their estimated income or 10% of their annual income. And those rules are there to protect the consumer, which is important. You know, they're very regulated by the SEC. But that has a $1,000 minimum with a very short 12-month tie-up period as well. Both of them are friendly to your self-directed accounts for anybody listening. If you're not familiar with how to utilize those and you have stagnant 401ks that are from a previous job, there's opportunity to move those kind of accounts over there and get them working for you. So again, both of those are friendly to IRAs. And they are both fully audited by an outside auditing firm. That's another really important fact. We do not do any of that internally. We do accounting internally, but we have a third party with their eyes on our funds to make sure that we're compliant with the SEC and everything is as it should be. I think there is a lot of fraud in this marketplace right now, especially among alternative investments. So for any of you listening, if you're out there talking to sponsors and operators like myself, you should be asking that, how do you guys maintain audits? And if they're telling you that they do that internally, that's something I would dig a little further into, because there's a lot of room for error when there's not a third party with eyes on things.
And I think that's really good advice, right? To have a third party outside firm come and audit. I think I've had roughly maybe 9 or 10 different syndicators on the show since we've started this show. And I think you're the first one that actually says, hey, look, we actually have an outside firm auditing us. I'm not saying the other ones didn't, but the other ones never came out and said, hey, look, we're transparent and we have an auditor.
Well, I bring it up because it's came up a lot over the last 12 months. I think when we were in the market, we were 12, 24 months ago, and everybody was making lots of money in real estate. One of the things that I feel like I've seen over the last 12 months is the really good operators have continued to be great operators, and the bad ones have started to become uncovered. And I've heard some horror stories from clients of mine that have invested money other places. And one of the common things that come up is they weren't auditing their funds. And to be honest, typically an accredited investor fund, the SEC doesn't typically require that because their opinion is, well, the wealthy can afford to be riskier, right? Risky and not educated and not being smart about where you're putting your money is two different things. And it just has been uncovered a lot lately. So I'm pretty passionate about it. And again, we're not even required with our accredited fund to do it, but we always have for the last 10 years. It protects the sponsor as well as the consumer, right? And so, it's something I like to talk about because I think it's really important. And it's, like you said, they may very well audit them outside. They just didn't bring it up, which, doesn't mean that they're not doing it.
And I'll tell you that usually one of the first questions I get when I speak to my friends or relatives and I say, hey, listen, have you ever thought about doing a syndication rather than just putting all your money in a mutual fund, just diversify a little bit? Have you ever thought of a syndication? Almost the first question out of their mouth all the time is, how do you know it's not a scam, right?
I know.
And I say, well, are they audited? Yes or no? And any paperwork you get, go to your lawyer, pay your lawyer a few $100, have them look it over, make sure it's above board, and then hope for the best. Yeah.
Yeah. Well, it's unfortunate that a few bad actors out in the industry, have, it's not bad though, right? Like when that stuff happens and it comes to fruition, it makes people look a lot deeper at things, and I think it's human nature to trust people. But again, this is your hard-earned capital. People work their whole lives to save this money up so that they can retire and have the kind of lifestyle that they've come accustomed to. And it's important to do your due diligence. I just did a webinar Wednesday all on due diligence on operators, like things people should be asking me, and so it's okay to ask questions. And if you can't get your questions answered, that's probably a sign it's not the right investment for you.
Well said. Yeah. And sadly, in this world, you can't really avoid risk. People always think that there's some magic button or process that eliminates risk. And it's like, no, you can't eliminate risk. Like even in the stock market, you have companies like Enron and WorldCom, there's no 100% guarantee that something is going to work out, but you can take steps to kind of tip the odds in your favor.
Agreed. Yeah.
I just want to say, Heather, I love your website. So I checked out your website earlier, and I love simple website design. And so your landing page just basically has a bunch of balloons, 3 or 4 balloons, and saying, hey, here are some of the funds we have open. Here are some of the investments. Here's the expected return, etc. And I think it's a great way to just cut through a lot of the sort of minutia and say, this is what we're all about. Check it out. And so if someone were to say, click on one of those funds, tell us what kind of returns have you been experiencing with them historically, and what is your outlook on the market going forward?
Yeah. And we always talk in historical returns, for our legal ease on the podcast and my legal to be included in that comment. We always have to speak in historical rates, and it's not a guarantee of future performance. Our accredited investor fund has a lifetime annual yield of over 10%. So that fund consistently hits 9 to 11% every quarter. And that is an annualized yield. It's a pretty well-oiled machine. It's been around a long time. There's a lot of assets in it. Our unaccredited investor fund has historically been hitting 7 to 8%. And the difference the biggest difference between the rates of return is what's called a preferred rate of return. So with our accredited investor fund, it has a preferred rate of 9. Our other fund, Fund 3, has a preferred rate of 6. And for those folks on the podcast that don't know what that means, it's not a guarantee. It's just the way that a payout occurs. And it means that once a management fee has been paid out of profit, then those preferred rates have to be hit in that quarter before we share in any profit above and beyond that. So once that 6 or 9% is hit and paid out to the investors for that quarter, then anything above and beyond that is split 50-50 with us. And it's really a way, some people are like, well, I don't want to split profit with you. Well, we're doing all the heavy lifting, and it's important to know how payout structures work so that that sponsor is motivated to keep hitting a higher yield for you. If they pay themselves out a bunch of money up front, a management fee is really to keep the lights on and pay a staff to manage a fund. And what keeps you motivated as an operator is like, hey, we got to hit 9 in this before we even share in anything above and beyond that. So again, preferred rate's not guaranteed, but just so that you guys understand, well, why is one paying 7 to 8% and why is another paying, between 9 and 11%? It's because that preferred rate is different. And quite honestly, if you're putting $50,000 in and this guy's putting $1,000 in, it should be a higher yield, right? You're putting higher dollars in. But like I said, there's still really good returns. They're also, like I said, just to kind of reiterate, all secured by real estate assets. So when we're lending the money out, the funds are the lien holders against those properties, first liens. And when we're buying those properties, the fund is the owner of those. We are simply the fund manager on behalf of the funds.
And I think it's important because if there's a default on that property, then you are the first person who can basically move forward and reclaim some of that lost money. So I think that's really important to state.
Yeah.
And so I'm curious, how did you land on single family homes? Because most syndicators go for the multifamilies or for the like storage units, et cetera. How did you end up in the single family space?
Well, our founder was big in the single family space. I mean, he's done every, buy, sell strategy out there from fix and flip to, wholesaling. When we started 11 years ago, we didn't want to try. I see a lot of operators that try to do everything, right? We buy multifamily, we do self-storage, we do residential, we do commercial. We wanted to stay in our lane. We also like that residential space because when markets start to shift quick, I mean, commercial is a perfect example. What happened in COVID? Nobody went into the offices anymore. So if you're all in commercial, what are you going to do with those commercial buildings, right? We like the residential space because when markets start to shift, like we've seen in the last 12 months, what happened? Interest rates went up, property sales cooled off. The reality is when you're in the affordable residential housing market space, those kind of houses you can typically rent and cash flow and ride out market waves, right? When you're in those high-end jumbo, homes, once you get above an FHA cap, the pool of buyers that you have decreases greatly, right? Because not everybody can qualify for a jumbo home loan, especially with the interest rates that they're at right now. We wanted to buy and invest in assets that we had multiple exit strategies on. Great. If we can fix and flip it and make a great profit for the fund, wonderful. We're going to do that. But if we can't, we can always rent them. As property sales cool off and interest rates go up, what goes up? Typically rental rates go up. So if we had to hold an asset for a year or two to ride out this wave, then we could turn around and sell it. When interest rates start to come down, prices go back up, and then we sell it. So that's really how we landed there. And again, we wanted to just stay with our core competency. That's what we know and understand. That's what we teach our clients to do, that are the active, hands-on clients. And we wanted to practice what we preach. So that's really where we landed there and have decided to stay there. And the other thing I would say is, you're going to find a syndication out there where you could probably get 18 to 20% IRR on your money. What I don't think a lot of people understand is that's a long-term investment, right? There's probably bigger upside in something like that than what our fund is going to pay you, but that's going to happen in 3 to 5 years, right? You're probably going to get paid a 6 to 8% preferred rate after the first year. And then when your big win happens is when they sell that property, right? They bought a distressed asset, they get a value out on it, and they sell it. Ours is just a steady Eddie fund, right? For someone that just wants consistent cash flow, doesn't want a long-term tie-up period, that's what our fund offers. And so we have the ability to do that through the residential assets that we buy and invest in.
Very cool. Heather, where can people reach out to you personally and to learn more about Secured Investment Corp?
Absolutely. Always go to our website. Like you said, we've got quite a bit of information on there. securedinvestmentcorp.com. They can schedule a call with me and my team. We're a big company, but my department is 5 of us, and they can schedule a time to discuss things further if they have additional questions. But always go to the website. That's always going to be securedinvestmentcorp.com. And once they get on there, if they put their information in, they'll start to get invited to our monthly webinar that I do. And it's always on a different topic. Next month, we're going to talk about self-directed accounts and probably have a guest speaker from a custodian. So we always like to grow that pool of followers. So I would suggest mostly the website.
Sounds good. I'll put those links into the show notes. Before I let you go, Heather, I'm really curious, what is your outlook on the real estate market?
Yeah, we talk about that on a daily. We still think there's some opportunity in residential. There are starting to be more foreclosures come to fruition. We had a kind of a lull in that, which for investors like us, that's where we buy a lot of deals, or we buy off-market deals, distressed sellers and things like that. We still see opportunity to buy, and we're well positioned cash-wise to take advantage of those opportunities. We feel like interest rates are leveling off. They're not going to come down. We kind of suspect Q3 there might be another increase in rates, but for right now, for the next quarter, probably into Q1 of next year, those are probably going to stay about where they are now. We're starting to see in our local market property sales pick back up again. We're not seeing values increase like they were, but they haven't declined. We're in kind of a interesting area, the Pacific Northwest. We've had a lot of influx from California, Seattle, Oregon as well, moving here. So we still see opportunity there, but we're also proceeding with caution too. You know, one of the things that I think is a challenge for, you know, operators and sponsors like us is you raise all this capital, then you got to deploy it, right? Like that's how you make money for people. And you can't get too anxious to go into a deal, you know, and get into a bad deal. And so we are proceeding with caution on the debt side of things. We just changed a bunch of our guidelines this week. We found some distressed areas because we do lend nationwide that we were lending in, and we decreased our loan to values to 50% because of these areas. So I think you have to keep a pulse on the market, and nobody really knows. I don't have a crystal ball, you know, and we're probably a little more in touch with things locally, you know, where we're located. But because we are a nationwide lender, you know, we have to meet on our portfolio multiple times a week to say, hey, do we see any problems coming? You know, are our borrowers having a problem exiting our loans? Are they not selling these properties and now they can't pay their loans off? What does that look like? Are values declining in certain areas that we're lending in? And that's, you know, goes to the point that we've changed some of our loan to values. So we still think there's opportunity in the market. We also feel like there's some opportunity in small multifamily, like mom and pop, you know, under 30 unit apartment complexes, as well as some mom and pop landlords selling rental properties, turnkey properties that are just kind of tired of dealing with tenants. And, you know, they've changed a lot of tenant laws, which favor tenants more than they do landlords. And I think there's some opportunity to buy those kind of properties with, you know, some smaller landlords that are just tired and ready to cash out. So that's kind of where we see it right now.
Heather, thank you very much for joining us today. I'll put all the links into the show notes. Yeah, it was a pleasure talking to you, and have a wonderful day.
Yeah, you as well. Thank you, Gabe.
Hey, thanks for joining us for another episode of the Money Seat Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.